Today, we are taking a deep, entirely jargon-free dive into one of the most fascinating corporate evolutions in history. Whether you use their products every day or you're just keeping an eye on the markets, you absolutely need to understand Microsoft's massive scale, its stock performance, and its aggressive pivot right into the absolute center of the artificial intelligence era. Get ready, because we're going to break down exactly how this company operates today. You know, when I say Microsoft, it's super easy to just picture a classic Windows desktop, right? Well, actually, scratch that. We need to shatter that illusion right out of the gate. If you still view them as just a Windows company, you are missing the much bigger picture. Today, Microsoft is a nearly $4 trillion powerhouse. It is definitely not a legacy fossil. It's basically the primary architect of the entire generative AI economy, providing the absolute bedrock infrastructure that powers everything from massive global enterprises down to the most cutting-edge AI startups. Okay, let's dive into this. Here's our roadmap for today. First, we'll look at the modern Microsoft empire, decode their economic moat, check out their financial health and segment trends, see how they balance efficiency with AI, explore their custom chip vision, and finally wrap up with their 2026 outlook and risks. Starting off with Section 1, the modern Microsoft empire. To really grasp the stock, we first have to understand exactly what the company sells today. Microsoft basically operates a diversified, highly profitable business model built across three distinct layers. First up, productivity and business processes. Think Microsoft 365, Office, Teams, and LinkedIn. Second, we have the intelligent cloud, which is anchored by Azure, their massive cloud platform, plus tools like GitHub. And third, more personal computing, housing Windows, Xbox gaming, and search. Now, here's a literally mind-blowing takeaway. Windows is now well under 20% of their total revenue. The real economic engines driving Microsoft today are cloud consumption and enterprise subscription models. Just look at how this breaks down. In Q3 2026, the productivity segment brought in a massive $35 billion, closely followed by the intelligent cloud at $34.7 billion. Meanwhile, more personal computing sat at $13.2 billion. This perfectly illustrates how intelligent cloud and productivity are the true twin engines of the company's financial success in 2026. They've completely shifted away from being a component-driven company to one that is totally driven by cloud capacity and subscription-based productivity. Which leads us perfectly into Section 2, Decoding the Economic Moat. A moat is just a fancy way of describing a company's ability to maintain its competitive advantages. Wall Street completely agrees with this dominance. Morningstar assigns Microsoft a wide economic moat. And what's the primary driver? Switching costs. Sure, they also benefit from network effects, meaning the more people use tools like LinkedIn or Windows, the more valuable they become. But the real superpower here is the sheer, undeniable pain of trying to leave the Microsoft ecosystem. Let's break that jargon down. Switching costs are basically the financial and operational headaches a company faces when trying to change software vendors. Think of it like trying to cancel a gym membership, but for a global corporation with 100,000 employees. Once an enterprise puts its document formats, meeting records, approval flows, and communications into Microsoft 365, leaving is just, well, it's a nightmare. Industry research estimates the switching cost at over $2,000 per seat. Multiply that by hundreds of thousands of employees, and leaving Microsoft becomes virtually unthinkable. But wait, it goes even deeper than that. Analysts call Microsoft's setup a three-layer crosslock. It's basically the moat of the moat. First, you've got the infrastructure layer with Azure powering the data. Second, the workflow layer with Microsoft 365, where employees actually do their jobs. And third, the developer layer with GitHub, where millions of engineers build code. Microsoft is the first company to reach impossibly high switching costs at all three layers simultaneously. A competitor would literally have to beat Microsoft in cloud computing, Office software, and developer tools all at the exact same time to truly threaten them. Good luck with that. Okay, let's move into Section 3, Financial Health and Segment Trends, to see how this moat translates to cold, hard cash. I want you to anchor your attention on this massive figure, $101.8 billion. That was Microsoft's total net income for fiscal year 2025, sitting on over $281 billion in revenue. Let that sink in. Why does this matter? Because this immense free cash flow is exactly what allows them to confidently fund massive AI research, while still returning billions to shareholders through dividends and stock buybacks. Their underlying financial health is undeniably rock solid. Now, if we look at the recent Q3 2026 trends, we can see exactly how these different segments contribute to total operating income. The intelligent cloud segment is absolutely surging ahead with 30% year-over-year revenue growth. Productivity is growing at a very healthy 17%. Meanwhile, more personal computing actually saw a slight 1% decline. This shows how the high-growth, high-margin cloud segments are easily making up for cyclical hardware and gaming slumps, completely stabilizing their overall operating income. Which brings us to Section 4, balancing efficiency with AI. This is the central tension of Microsoft's current strategy, because building the future is definitely not cheap. So there's a fascinating contrast happening between Microsoft and its clients right now. On one hand, integrating tools like AI Copilot into Microsoft 365 drives massive project efficiency for clients, which lets Microsoft upsell to premium pricing. But internally, building the immense AI infrastructure to actually run those tools causes heavy depreciation costs, which slightly squeezes Microsoft's own short-term margins. It's a tricky balancing act. And the cost of that infrastructure is staggering. By 2026, Microsoft's annualized AI revenue run rate hit $37 billion. But they are also spending massive amounts on capital expenditures. We're talking tens of billions every quarter just to build out servers and data centers. The key takeaway here is that Microsoft's management is deliberately choosing to sacrifice a bit of short-term quarterly profit padding in order to secure long-term sustainable market dominance in the AI space. So how do they plan to make those massive AI investments more profitable over time? That brings us to Section 5, the custom chip vision. To lower the immense cost of running AI, Microsoft went ahead and developed its own custom inference chip called the Maya 200. In early 2026, CEO Satya Nadella announced that this new chip delivers a 30% improvement in tokens per dollar efficiency compared to older silicon in their fleet. This is a total game changer for their project margins. By building their own chips, they rely a lot less on expensive external vendors, which directly improves their overall operational efficiency and lowers the cost of serving AI models to you and me. But the crucial point is how they plan to scale this. In mid-2026, reports emerged that AI company Anthropic was actually in talks to become the first external customer to rent servers running the Maya 200 chip. If finalized, this is huge. It validates Microsoft's custom hardware against industry giants like NVIDIA. Plus, it shifts portions of a massive $30 billion compute commitment Anthropic made directly into higher-margin Microsoft chips. This perfectly highlights how future phase opportunities and hardware expansion really support their long-term growth and profitability goals. Let's see how all this builds into our final section, 2026 Outlook, Risks, and Disclaimer. How exactly is Wall Street digesting all this complexity? Well, we've recently seen a major valuation re-rating. Back during the AI hype peak of 2025, Microsoft's price-to-earnings ratio was way up around 38x. By early 2026, that compressed down to roughly 25x. Why the drop? Because investors transition from just being excited about the potential of AI to rigorously focusing on the actual profitability of AI and those massive capital expenditures we just discussed. And as we look toward 2027, Microsoft definitely faces some headwinds. They have to manage the ongoing decline in their legacy on-premises software. They have to navigate these incredibly high hardware expenditure cycles. They're also facing increased international regulatory scrutiny regarding their investments and data practices in regions like Europe and Asia, which, let's be honest, is impartially just a geopolitical reality of operating at a global scale today. Finally, there's a growing demand for sovereign AI, where nations want their data stored locally, which means Microsoft has to build even more specialized regional data centers. Yet despite those risks and the massive capital layout, the long-term vision remains highly optimistic. Wall Street analysts forecast that Microsoft's annualized revenue growth will actually accelerate to 16% through 2027. That is faster than its historical 5-year average of 13%, signaling strong confidence that this huge transition to cloud and AI will ultimately pay massive dividends. Which leaves us with this final thought. Microsoft is no longer just a software company. It's a deeply complex, 3-layer empire that is literally building the infrastructure of the future. The question isn't whether they are spending a lot of money. They absolutely are. The real question is, will this massive AI bet further deepen their unshakable moat, locking in the enterprise world for the next decade? It is going to be a fascinating space to watch. And finally, as a mandatory reminder, the information presented in this explainer is strictly for educational purposes. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions in Microsoft or any other company. Thanks so much for joining me on this deep dive.